Before the year ends, there are 7 things I recommend you do if you want 2026 to be a strong year financially. These are simple, practical steps that will give you clarity on where you stand and help you optimize a few important areas before the year closes out. Because let's be honest, we've just experienced one hell of a year as investors. We saw one of the fastest market crashes in recent history, followed by an equally impressive recovery, all within a few months. And in a year like that, it's very easy to get to December and realize you've been so focused on the day-to-day that you never really zoomed out to look at the bigger picture. So today, let's go through these 7 things together. It's exactly what I'm planning to do myself over the coming weeks. And if you only do one of them, make it number 7. If you're new here, my name is Angelo, and I've been investing in low-cost ETFs for over 8 years together with my wife, with the goal of being able to retire early in Europe. Let's start with the foundation, knowing your actual number. Your net worth is simply everything you own minus everything you owe. Add up your investments, your savings accounts, cash, and any other assets. Then subtract any debt, like loans, credit cards, or mortgages. Now, I'm not suggesting you obsess over this every month. Markets move, portfolios fluctuate, and checking too often will just drive you crazy. But once to twice a year, that's the sweet spot. Year-end is perfect because it gives you a clear starting point for 2026, which you can then compare to previous years to see how much progress you made. My wife and I track this in a simple spreadsheet. Nothing fancy, just the total value of our ETF portfolio, our small speculative allocation to Bitcoin, our emergency fund in cash on Trade Republic, minus any liabilities. For me, that's upcoming tax and social insurance payments since I'm self-employed. It usually takes around 10 minutes and gives you a lot of clarity on where you actually stand. Next, let's talk about your cash. How much money do you have in savings right now, and is that amount appropriate for your situation? A common rule of thumb is to keep 3 to 6 months of living expenses as an emergency fund, so you're covered if you suddenly lose your job or your car breaks down. My wife and I usually keep around 6 months since I'm self-employed, so my income can be unpredictable. And if you're planning a large upcoming expense in the next 1 to 5 years, like an apartment, house, or wedding, try not to take investment risks with that money. Keep it in a high-yield savings account or in a Euro money market fund instead. Ideally, something safe and easily accessible, earning interest while you wait, so you're not forced to sell investments at a bad time. This next one is time sensitive, so pay attention. Depending on where you live, there may be opportunities to reduce your tax bill before the year ends. One common strategy is tax loss harvesting. This simply means selling investments like stocks or ETFs that are currently in the red to realize a loss, so you can offset any gains you realized earlier in the year. Let me give you a quick example of how this works. Say you sold some Nvidia shares earlier this year and made a 2,000 euro profit, but you also have another stock, Rheinmetall, that's currently done 1,500 euros. If you sell that losing position before year end, you can offset the 1,500 euro loss against your 2,000 euro gain. As a result, you only need to pay capital gains tax on the 500 euro difference, not the full 2,000 euros. Here in Austria, you can only offset losses against gains within the same tax year. We can't carry losses forward like in many other European countries, which makes this even more time sensitive. Just don't wait until the last week of December. Some markets have limited trading hours around the holidays, so give yourself a bit of a safety buffer. Of course, tax situations vary by country, so make sure you understand the rules where you live. For those of you in the UK, you might also want to check if you've used your ISA allowance for the year before it resets. Number 4. When was the last time you really looked at what you're holding? After a year like 2025 with markets crashing and recovering so dramatically, your portfolio allocation might have drifted from your original target. Maybe you wanted to have 60% in US stocks and 40% in stocks from the rest of the world, but after the latest AI rally, you find yourself at 70% US stocks and should consider rebalancing. Now, instead of selling the winners and triggering a tax bill, consider simply targeting new investments towards the underweight portion of your portfolio until things balance out naturally. Also, this might be a good time to ask yourself if your portfolio is more complicated than it needs to be. Perhaps you're holding many different ETFs, some of which even overlap in their holdings, when 1 or 2 would do the job just as well. This is something I've talked about before, but complexity rarely leads to better returns. What it does lead to is more decisions, more rebalancing, more chances to second guess yourself. My wife and I I like to keep things as simple as possible. One global ETF covering thousands of stocks from all across the world. We do keep a speculative 10% allocation to Bitcoin as well, which sadly performed far below expectations this year, but that's a topic for another time. If you're currently holding a bunch of different funds and you're not sure why, year-end is a good time to reconsider if you're still aligned with your long-term strategy. You don't have to sell anything, but you could simplify things going forward by directing all new investments into a single ETF, for example. We're also still holding on to our existing Vanguard and Xtrackers World ETF shares we've accumulated over the past 8 years, as they're still in line with our long-term strategy, and selling them and realizing taxable profits before we actually need the money in retirement wouldn't make sense. By the way, you can find my link to Interactive Brokers, my favorite locals broker for stocks and ETFs in Europe, down below, which is a great way to support me if you'd like to. Now here's something that takes a bit of effort but can save you hundreds of euros per year. When was the last time you reviewed your recurring bills and actually tried to negotiate a better deal? I'm talking about your internet contract, phone plan, or insurance policy. This is something I do once a year with my internet provider here in Austria. I simply call them, mention that I'd like them to make me an offer to renew my commitment for another year, and more often than not, they give me a discount or a free upgrade to keep me as a customer. The same goes for electricity. I usually review and switch providers once a year using online comparison tools, which typically saves us a few hundred euros annually compared to just sticking with the same company. This might work differently depending where you live, but it's still worth looking into. Beyond bills, I also recommend reviewing what tend to be the 3 largest recurring expenses for most people: housing, transportation, and food. Are you being intentional with these, or are there areas where you could optimize without giving up quality of life? Perhaps you would be happier in a smaller, less expensive apartment if it meant you needed to work less to pay for it and had more free time instead. Maybe you're paying for a car you barely use when public transport would work just as well. Maybe you're eating out more than you realize, and cooking at home a few more times per week could make a meaningful difference. Just to clarify, I'm not here to tell you what you should or should not spend your money on. All I want to do is to remind you to take a step back every once in a while, analyze where your money is going, and make sure that's in line with what you actually value in life. Now let's look at how you did this year. Your savings rate is one of the most important numbers in personal finance, yet most people have no idea what theirs is. It's very simple to calculate. Take the total amount you saved and invested this year and divide it by your total net income. For example, if you earned 30,000 euros after taxes and saved 6,000 euros, your savings rate is 20%. So how did you do in 2025? Are you happy with your number? If not, now's the time to think what you could change for next year. And if retiring early is your goal, your savings rate is your most important number. Thanks to our comparatively high income and low expenses as a family of 3, we currently have a savings rate of 64%. But we're aware we're in a lucky position, and we've been diligently working towards our early retirement goal for over 8 years now. So don't be hard on yourself if you're currently at 5 to 10%. You're still intentionally moving closer to your financial goals, when you could have easily spent your entire paycheck month after month like most people do. If you want to raise your savings rate next year, you really only have 2 options: earn more or spend less. Ideally a combination of both. Now that you have clarity on where you stand, let's make sure next year runs on autopilot. The best investment strategy is the one you can stick to without thinking about it too much. And the easiest way to do that is through automation. Most brokers now offer recurring investments, where you can automatically invest a set amount into an ETF of your choice at regular intervals. My wife and I have this running at the start of each month as well. Here's mine on Interactive Brokers. As long as you switch to tiered pricing in your account, you'll only be paying as little as €1.25 in fees for orders up to 2,500 euros each time. Just make sure you wire the money to your brokerage account in time, something you can also automate using a standing order with your bank. Once again, you can find my link to Interactive Brokers down below if you'd like to support me, as I don't do sponsors. Now, the main benefit of automating your investments isn't just the time you save. It also removes the decision making when markets look scary and emotions could otherwise get the better of you, leading you to try things like timing the market, which rarely works out in your favor. Look, you don't need to do all 7 of these perfectly. Pick the 2 or 3 that matter the most to your situation and actually follow through. That alone puts you ahead of most people who will start 2026 exactly where they are now. Beyond these practical steps, I would also encourage you to set 1 to 2 simple financial goals for the new year. Maybe it's increasing your savings rate by 5%. Maybe it's reaching a specific net worth milestone or building the habit of investing on a monthly basis. Whatever it is, write it down somewhere you'll actually see it and give yourself something clear to aim for next year. All in all, 2025 was a wild year for investors. We saw periods of panic followed by a massive AI-driven rally and market sentiment often switching between fear and greed. If you stuck to your plan through all of that, well done. That's not easy. And if you made some mistakes along the way, don't be too hard on yourself. Learn from them and set yourself up to do better next time. Which of the 7 things I mentioned today are you going to put into action before the year ends? I'd love to know in the comments. And if you're worried about an AI-driven stock market bubble, which so many have been talking about lately, this video is for you. Please don't forget that none of what I mentioned today was meant as investment advice. I'm just openly sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching. Have a wonderful week, and until next time.